Montaka's Spotlight series explores the principles that underpin Montaka's high-conviction global investment strategy. Join Chief Investment Officer Andy Mackin and Portfolio Manager Chris DeMasi as they continue their journey in long-term compounding.
Hi everyone, it's Andy here. In this month's Spotlight series, we share a recent presentation we delivered to the 2022 Asian Investing Summit. This is something that MOI Global hosts each year, and we were delighted to participate again in 2022. Our presentation is on China's Alibaba, and we detail why Alibaba remains one of the most undervalued digital assets in China today, notwithstanding the very long list of regulatory and competitive headwinds the business has faced over the last year. Enjoy. I thought just to provide a little bit of context into how we invest and what we think works for long-term investing. This is really our formula for success, and in terms of what we look for, it can really be summarized by this Venn diagram. So really we're seeking to identify large, reliable structural transformations that carry with them favorable economics. And then to the extent we can identify businesses which are high probability long-term winners within that transformation, and to the extent we can assess that they're undervalued, then that's what we want to own. It's as simple as that. And we think, over the years we've evolved our structure, our corporate structure, and certainly our internal culture now to be able to hold these sorts of businesses through drawdowns and for the long term. And my presentation today is going to be on Alibaba. And so for anybody who's been following that stock price of late, that ability to hold through drawdowns is absolutely key. So let's get started on Alibaba. And I guess I want to get a few things out of the way right up front. First of all, I apologize in advance if I mispronounce any Chinese names. That's not my intention, but I'm sure I will. Second, for this presentation, I'll just keep everything to US dollars, just save everybody converting between renminbi and other currencies in their heads. And look, I also realize I'm not the only investment analyst on planet Earth to have ever looked at Alibaba. So this presentation will assume some basic background knowledge of the business. I'll probably spend more time focusing on how we think about the investment thesis rather than, a deep dive on each individual subsidiary business, because we'd be here all day. But I will just touch on them right up front. So the chart showing at the moment really demonstrates how Alibaba is really a portfolio of complementary businesses that seek to grow network effects and data advantages, as we'll discuss throughout the presentation. So just to spend a minute on kind of the various businesses within the group. For this presentation, I've drastically simplified. I like to simplify things, but I've probably oversimplified Alibaba down to just two main businesses. One I'm just calling consumer businesses, which is 91% of total revenue and all of the profits, and then the other business in cloud computing, which today is 9% of revenue, but 0% of the profits. It's basically at break even today. Now, within the consumer businesses, of course, there's the core Chinese domestic commerce businesses, which interestingly, collectively represent the largest retail business in the world based on GMV, or gross merchandise value, and that's running at about $1.2 trillion per year. So these, of course, include the major third-party marketplaces such as Taobao and Tmall, as well as Alibaba's integrated online-offline first-party formats such as Sun Art in the supermarket space. Then there's the international commerce businesses led by Lazada, which is, of course, a leading player in the Southeast Asian markets. And both of these commerce businesses are supported by Canal for logistics infrastructure. And Canal basically leverages a network of third-party logistics providers And then we have other bits and pieces, other consumer services, from food and grocery deliveries to restaurant guides to online travel bookings to digital media, entertainment services, including Youku, the long-form video platform. And that collectively, we'll call that consumer. And then the second part, which I'll touch on as well in the presentation, is of course the cloud business. And you can think of the various offerings within cloud along similar lines to how the Western hyperscalers structure their cloud businesses. So you've got different layers in the stack, so to speak. So you've got the cloud infrastructure, just the core computing infrastructure, up to platform service offerings, including artificial intelligence, things of that nature, and then with applications sitting on top, such as DingTalk, which is an enterprise collaboration application, similar in many ways to Microsoft Teams. So that's probably a world record in summarizing the Alibaba Group. But given that summary, I then just want to give a brief summary of the recent headwinds that this business has faced. And there's certainly been no shortage of negative news flow for Alibaba, as well as really the Chinese internet industry over the last year or so. And I won't go through all the announcements, but starting from when was it? Almost 18 months ago, the famous Ant IPO that got halted by Chinese regulators. Fast forward to around about a year ago, Alibaba was fined for monopoly abuses. We've had new regulations come in which have affected Alibaba as well as many of Alibaba's peers. Throughout this period, in the midst of all the turbulence last year, Alibaba announced that they believed that the best way to overcome these challenges was actually to invest all of the company's incremental profits for the coming year into strategic areas. And, we interpreted this almost as a form of penance, as a sign of goodwill or gesture of goodwill or good faith to regulators that, they'd sort of learnt their lesson and would change their ways. And then if that weren't enough, we even had just in days ago, JP Morgan made the now famous announcement that Chinese internet was basically uninvestable over the next 6 to 12 months. And we've seen extreme volatility in the stock price, not only over the last year, but particularly over the last couple of weeks as well. So that's the context. And if you want to be negative on a stock, Alibaba will also give you no shortage of reasons to avoid this stock if that's kind of the path you want to choose. Red flags would include increased domestic competition. Of course, Douyin, which is Chinese TikTok, is experiencing widespread popularity, as is Pinduoduo, JD.com. We're seeing strong competition outside of China as well in the Southeast Asian markets, such as from Shopee. Obviously, there's the regulatory crackdown that we've discussed. You might have concerns and legitimate concerns that the strategic investments that Alibaba announced last year of all the incremental profits. Now they said it would just be for a year, but maybe they're not for a year. Maybe they're going to continue that for the medium or even longer term. Then you've got the ongoing SEC crackdown on US listed Chinese companies, which relates to audit requirements and the ability for Chinese businesses to fulfill those requirements. Risks of delisting in the US. There are concerns around the longevity and effectiveness of the variable interest entity corporate structures, VIE corporate structures, which are probably well known, but essentially that's question marks over whether shareholders, can truly or do truly own, the underlying certain underlying assets? Well, the answer is under these structures, no, you don't, but they have been, the economic sort of interest has been replicated by contracts. And then, of course, you could say, well, how strong are those contracts? How much of an ability does a foreign investor have to enforce contract law in China? So, legitimate concerns there. And then, of course, you've got the geopolitical risks, cross-border trade disputes, risks of sanctions. Of course, that's become top of mind for investors in the last few weeks, given the situation with the Russian sanctions. So there's no shortage of red flags with Alibaba, and we think that in large part these concerns and others have driven a significant decline in the stock price over the last year or so. But really, it seems to us that when you compare the price of Alibaba versus its value, the difference today is really stark. And we believe that investors are drastically overweighting the risks that we've just discussed, and is creating a significant mismatch, if you like, between price and value. So if I first touch on price, which is the left-hand side of this chart, this is the sort of the deconstruction of the market cap between the enterprise value of the operating business, which is about $180 billion US. Then you've got some cash, you've got some equity investments, which includes Alibaba's interest in Ant Group. Of course, it's a very scaled down valuation of Ant. It's it's less than a third of the valuation at its IPO, which of course did not happen. But everyone's really scaled back their assessment of value in that business, and that gets you to the market cap of a little over 300 billion today. And then if you think about, so that's the left-hand side, that's what you sort of price is what you pay, and then of course value is what you get. So what do you get for $115 per ADS share price, or ADS price? Well, there are two parts, as we said. We're going to break this presentation up into sort of two parts, the consumer businesses and the cloud businesses. Well, on the consumer businesses, you'll see we assess that there's sort of a normalized free cash flow power. Think of earnings power, but convert it to free cash flow generation power of a minimum of 11 billion per year, and more likely up to 19 billion if those strategic investments that they have self-imposed strategic investments, if it turns out they are temporary, then the base is 19, not 11. And then if you say, well, at the limit, let's say there is no cloud business and all of the enterprise is just to do with the consumer businesses, well, then this would equate to a free cash flow yield of between 6 and 10% per annum. And it's not 6 to 10% just, like a bond, sort of a constant level. That free cash flow we assess will be growing over the medium term at least the teens percentage rate increases per annum. And we also note that the company is buying back stock aggressively each month, no doubt on the basis that these sorts of free cash flow yields relative to the value of the business today are extraordinarily attractive. So that's what you get on the consumer business. And then, if that weren't enough, so to speak, you also get the cloud business. And the Chinese cloud computing industry, within which Alibaba is the market leader, is set to increase around 6 times over the next 10 years to around $300 billion per annum. And the nature of hyperscaler incremental profit margins over time is that basically they're very high. It's a relatively fixed cost business, and network effects are strong, data advantages are strong, and the incremental profitability of these highly attractive businesses are really attractive over the medium term. So you can get, we're talking incremental profit margins in the order of 40%. And just on those basic metrics, we assess that just the cloud business alone is worth at least 100% of the total enterprise value of Alibaba today, given its ADS price of $115. So that's the summary. So now I just want to spend a few slides going into a bit more detail on what underpins our assessment of value, each for the consumer businesses as well as the cloud businesses. So we'll start with Alibaba's consumer businesses. As I said, the first point is to note that there is real value, we think, in owning a complementary portfolio of offerings. So as you can see from the chart, whether you're, as a consumer, you're sort of positioned in the value segments or premium segments, or whether your sort of engagement desires are sort of less time sensitive, more time sensitive, and around delivery times as well. Alibaba has an offering to kind of suit where you sit. And I mean, obviously, not only is that valuable because it increases your sort of addressable market, so to speak, within China, but Alibaba's also noted that there are network benefits associated with this. So they've observed that you do get higher retention for a user that sort of engages with multiple apps. That's positive in terms of retention. They also have their loyalty program, which is growing. Now, similar to Amazon Prime, the idea here is that users who pay up for the loyalty program, they not only receive discounts on Tmall and Taobao, they receive, food delivery benefits, they receive membership to video and music streaming services, etc. Again, not unlike Amazon Prime. But they also tend to spend more. Again, same deal as Prime. So they find that a consumer's spending grows by 30% on average after becoming a VIP member. And they also know that these members tend to spend a lot more than others on average. So, we're talking as much as 8 times more than the average user. And I think it's also worth noting as well that, like, Amazon Prime was launched back in 2005, whereas Alibaba's VIP program was only launched in 2018. So it really does demonstrate that Alibaba, what we're talking about here is sort of a business that has great characteristics and great network effects and data advantages, but is, call it round numbers, a decade behind Amazon. Now, of course, the recent context, which we've touched on, points that, well, given the recent context, I guess viewers and listeners would not be shocked to learn that Alibaba's gone through some challenging times. And you can see a series of charts here, but I'll sort of start with the 2 charts on the left-hand side and then go to the 2 charts on the right-hand side. So the 2 on the left kind of demonstrate a challenging period where, revenue growth has slowed. Now, there are quite a few factors here, of course. It's not just COVID, regulatory changes, recent macro headwinds, some competitive pressures. But then we've also seen profit margins have been declining as well, and that's the bottom left-hand chart. And you can see the blue bars. If you just looked at the blue bars, which is the annual profit margins, then oh my goodness, they're just straight down. But remember, a big chunk of that, especially in the last 12 months, relates to these self-imposed strategic investments. And if you strip those out, you get the sort of the pink bar for annual 2021. So that would have told a very different story. Of course, you sort of skip through it. 2020, of course, you got COVID. Then 2021, if that was the pink bar, sort of would sort of tell a different story to the one that's shown in blue. And then on the right-hand side, you sort of strip back and look at some of these important underlying metrics of Alibaba's consumer businesses, and they look pretty good. So monetization, just slow, steady, continual increase as a percent of GMV. You look at spend per customer, slow, steady increase. And arguably, that sort of spend per customer is even is a sort of a slight misperception built into that, given that Alibaba's been expanding into sort of lower tier cities. So you would think that once the growth of lower tier cities sort of slows down or maxes out, then the growth will actually be dominated more by your sort of more loyal, higher spending customers, and that will sort of really continue to grow well. So we look at this context, we look at what's happened, we look at some of these self-imposed strategic investments, but then we also look at some of the underlying core metrics, and we say, well, is there a misperception here? Does this thing look much worse than is the case in reality? And we think that is the case. And then we also think that, looking forward, the opportunities for Alibaba to grow are still quite significant. So, this chart shows just a couple of dimensions along which Alibaba can grow. So it shows on the horizontal axis, for instance, penetration by category within the existing customer base. And so, plenty of categories are quite lowly penetrated. So there's clearly some cross-selling opportunities there for Alibaba. And then on the vertical axis, you've got Alibaba's share within the category, which includes offline retail sales as well. So, even just as online penetration within these categories continues to grow in China, we believe Alibaba will naturally continue to participate in that growth as well. We kind of put it all together, and this is our final slide on the consumer businesses. And we really just want to lay out sort of the back of the envelope economics or the back of the envelope calculations that we use to get to the sort of the basic earnings power of this segment. And you can see we'll start with revenues. And again, putting aside that the current base of revenues is arguably depressed, but just put that aside and you say, okay, what's the medium-term outlook here? And within revenues, you can really break it up to, within consumer, China versus international. And China, we've said it's at least, 10% medium term, and that rate of growth is even less than just the aggregate rate of online sales growth in China over the medium term. And then internationally, it's higher. Again, even that number is arguably conservative because it's less than the rate of online retail sales growth in these sort of higher growth regions. You put them both together and you say, okay, well, the top line is arguably, teens percent per annum. Then you take the EBITA margin of 14% and you say, okay, what's that going to do? Well, 14 includes 7% of strategic investments. So right there, if you think that those strategic investments are going to go away, that 14 becomes 21. So you can sort of take your pick. International is currently loss-making to the tune of 1%. Over time, that'll, 1% loss will go to break even, which will go to positive margins. So there'll be a little bit of a tailwind there. And then we don't even have to assume anything about, standalone profitability in the logistics or consumer services businesses. The way we actually view those is that they're really supporting, they're like cost centers, if you like, or loss leaders, if you like, to support the Chinese and international retail businesses. So yeah, where do we get to? We get a teens % top line. We get to an EBITA margin, which is increasing. And that sort of gets you to a free cash flow power of a minimum of $11 billion, growing at teens % per annum or significantly higher than that. And this is just for the consumer business. And as we said right up front, this is relative to an enterprise value of the entire group that is only $180 billion. So now let me just spend a few moments on Alibaba's cloud business. And look, we believe this business is extraordinarily valuable and goes largely overlooked by many investors today because its profitability today is zero. It's break even. And so, it's doesn't add much to your sum of the parts when you look at just today's earnings. But, the very high level starting point is that China is the second largest economy in the world and growing. And Alibaba Cloud is China's largest cloud provider and really the most advanced in platform services such as artificial intelligence. And we believe that the cloud space in China over time will be hugely valuable and Alibaba will play a significant role in that. I won't go through all the bits and pieces. The graphic that's shown on the page just shows all the different layers within the cloud business. But you can see, there's that infrastructure layer, then the digitalization layer that sits above that. You can sort of think of that as a bit like sort of the platform as a service to relate it back to, what we're used to over in the West with the hyperscalers. On the very top, you've got various applications that sit on top and leverage the platform services. And then the second from the top layer is, industry solutions, which is just another way of saying, not unlike the hyperscalers, that, they package up applications in a certain way, to tailor offerings for different verticals. As I said, we see China's cloud market as structurally growing and with privileged economics. So that's certainly a transformation that would interest Montaka. So let's unpack that a little bit. As I said, long-term transformation, sort of call it 6x over the next 10 years. The economics of this transformation are attractive primarily due to the high barriers to entry. And the high barriers to entry in cloud computing are driven in part by scale, and also in data, scale in data as well, I guess you could argue, and the data advantages that come with having extraordinarily large and growing data sets. The industry structure in China is attractive, again, not unlike the attractive industry structure in the West. But in China, it's an oligopoly between Alibaba, Huawei, and Tencent. We would argue there's regulatory protection from Western hyperscalers. Obviously, you're not going to see AWS or Azure or Google Cloud, hosting, the IT infrastructure of Chinese corporates and government agencies. This is important that in our minds the nature of data advantages, in particular as they relate to artificial intelligence, are self-reinforcing. So and that's just the nature of AI, meaning that the early winners keep on winning. Because the early winners in AI drives more adoption, gathers more data, retrains the models, the AI models to make them more accurate, which drives even more adoption, get more data, and so on and so forth. Vertical integration into chip design is a kind of an interesting and potentially powerful second order effect of leading artificial intelligence capabilities. Today, what we're seeing in the Western world, for example, is that application-specific chips that are required to run AI models more efficiently are actually being designed and optimized by AI models. So we're kind of already into that world over here in the US. And then, of course, the long-term winners in the space are known today, in our view, with a reasonably high probability. And they, of course, do include Alibaba. And so you put that together, you say, okay, really attractive transformation. high probability, we know who the winners are. And then, as we've said, the fixed cost structure of this space and the high barriers to entry result in high long-term incremental profit margins and high long-term returns on incremental invested capital over time. So that's really attractive in our view. And a quick aside, because I've sort of touched on artificial intelligence a little bit here, but without sort of turning this into an AI presentation. I just wanted to flag that we do believe here at Montaka that AI is going to drive much more demand for compute and storage than most appreciate today. And of course, if that's true, that will be really great for cloud providers, not only in China, but in the Western world as well. The quick summary of that thesis is that we'd argue that distributed computing is at an inflection point today. So it's not just computing inside the cloud or the data centers or the centralized the centralized conceptual cloud, but it's also out at what they're calling the edge. So, things like the Internet of Things, industrial sensors and whether it's vision on autonomous vehicles, or whether it's sensors in the factory or out on the oil rig. There are just this explosion of devices which is happening. You've got an explosion of devices, therefore you've got an explosion of software applications that are being developed for those devices. Even the development of software applications itself is being democratized with various low-code, no-code interfaces. I even saw the other day you can now there's an AI tool that allows you to convert natural language commands into Python code. So that's part of this trend towards democratizing the ability to create applications. And that's important because nearly every application today is increasingly leveraging AI models in one form or another. So all of this says that demand for AI models is increasing. And then the final part of the sort of premise is that we know that AI is much more compute intensive than other forms of software development. So enormously compute intensive to train these models. And then it's even still relatively compute intensive to sort of query the models each time when you want to, they call it inferencing, when you want to sort of ask it to make a prediction or make an interpretation. So we kind of put that all together, and we think that therefore there's a pretty good chance that the long run future demand for compute is probably underestimated. And when we look at all the total addressable market assessments out there for at least the Western hyperscalers, they really are based on the shifting of today's workloads into the cloud, and they have relatively little for sort of just new standalone workloads associated with the training and deployment of these sorts of AI models. So that leads us to be very optimistic, not only on the Western hyperscalers, but of course it has implications for our views on Alibaba's cloud business as well. So for anyone who'd actually like to read the the 5,000 word version of that thesis, you're welcome to download it. It's at montaka.com/AI. And then I guess while I'm at it, I will just add that we actually publish a lot of our research and thoughts, and you can either get that from, again, the website montaka.com and just hit subscribe, or you can find it on LinkedIn as well. So look, we'll leave it there. To summarize, we really believe that the market today is significantly overweighting the risks associated with investing in China, as well as the regulatory headwinds in the internet space. We look at price is what you pay, value is what you get. And we think relative to the, operating enterprise of $180 billion today, you can own the largest retailer in the world with large and growing network and data advantages, as well as the largest cloud provider, all in the world's second largest economy. And you get a set of free cash flows from the consumer businesses, which, as we said, are between 11 to 19 billion today and growing in the teens. And we also think that the cloud business, even on standalone, is probably worth at least 100% of the enterprise. So substantial upside, in our view, on a fundamental basis. And given that, it's really no surprise, therefore, that Alibaba continues to aggressively buy back their stock each month. And actually, we know even a week ago, they upsized their share repurchase program from 15 billion US up to 25 billion US. So again, just another indicator that they clearly believe that their shares are undervalued, like we do. So we just put it all together. We think that the risk-reward profile of Alibaba today is so favorable that it warrants, serious consideration for an investment.
Thanks for listening to Montaka's Spotlight series. For questions or feedback, please email question@montaka.com. Andy and Chris would love to hear from you.